Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Welcome to this week's episode of Investor Intelligence, the weekly podcast on all things investment, hosted by me, Jacob Kearns. It's not every day you get to sit down and have a conversation with someone who's been investing in property, or investing in general, but property in particular for the last 23 years, and also has been helping people for the last decade with his company, The Property Mentors, also investing and growing wealth through property. But today we get the chance to do that. So I'd like to welcome back to the podcast once again, Luke Harris.
Thanks, Jacob. Thanks for having me.
Always good to have you. So Luke, I want to sort of break this down into two parts, I guess. So you've obviously been investing yourself, helping friends and family for the last 23 years. And then, so obviously you've seen a lot over the years. But also with your company, The Property Mentors, you've been having a lot of conversations over the past decade. So let's start it off pretty high level. How has the market or property investing as a vehicle to grow wealth changed over the last, say, 23 years?
Well, 23 years and actually going into 24. So it's actually been a few property cycles during that time. Look, the market has had its typical ups and downs, as you probably expect. A lot has happened in the global economy and in the property markets here in Australia. And look, I guess going back in hindsight, if I knew what I knew today, I would have bought more property when I was younger. And I guess that's part of the advice that we give now to people through the Property Mentors is to buy property and hang on to it. Because I'm sure that if you went back to 2001 or 2000 when I was first buying property, if I could offer you a property today in any capital city in the country for the same price as it was back in 2000, you'd snap it up.
Yeah.
You wouldn't worry about the location so much. You wouldn't worry if it's an apartment or a townhouse. If it was a 2000 price, you'd probably snap it up.
Definitely. And for a lot of people, so the property prices have gone up, and a lot of people might be looking at the market, and if they're not as educated, they might be thinking they've gone up so much, how can they keep going up? And the words that you used was something along the lines of, if you bought a property back then, you'd want to buy more. So for people looking at investing today, you kind of spoke as if it will happen again. The same thing will keep, the same trend will continue. What makes you say that?
Well, I think we've got to look at what's happening. We've got to look at the data in Australia as far as population growth. If the population growth is increasing, obviously that needs to, all these people need somewhere to live. So it's not a finite number of homes that we're going to ever have in this country. With more people moving to Australia and population growth with, birth, deaths and marriages, as they say, the population is going to keep increasing. And if we don't, then that means the economy is going to start going backwards, and then we're going to have too many houses. And of course, governments at all levels and banks, of course, don't want that. So, yes, it will happen again, and it will continue to happen. It's not like it's ever stopped. It's continuing to increase, and the population continues to increase. The economy continues to grow, and obviously to tie into that is obviously the housing growth that comes with that. Our cities around the country, the big capital cities, the big four, are experiencing massive growth, and that they have done for the last few years, the last decade in particular, with a huge amount of construction and I guess a lot of consolidation in the big four cities with, I guess, building more in their existing boundaries rather than continuing to expand the city limits forever and a day. So what we'll see is that prices will continue to rise, and the market will go back to its long-term fundamentals of ups and downs and sideways, interest rate rises and various peaks and troughs. But property today is the cheapest it will ever be from this point forward. It's not going to be going down by 10 or 20% where people can snap up a bargain. It's only going to go in one direction, and it's either sideways or up. And over the long term, it's up.
Yeah. Yeah, it's interesting. You've definitely seen a lot of growth over the last 23 years, but what about the last 10?
The last 10's actually been quite an interesting mixed bag because the Property Mentors was established in 2014, and obviously that's a good 5 years after the impacts of the GFC. We've seen a huge amount of change in our government policy. We've seen, a lot of changes with first home buyer schemes and things like that. But we've also seen a few government changes, both at a state level and a federal government, that have had some impact on government policy around housing. But then, of course, we've had COVID most recently, and that still is a fresh memory for a lot of people, despite being almost 4 years ago now. The lingering effects of the COVID pandemic are still sort of around to a certain extent, and even as late as end of last year, we were still seeing issues with building supply issues and increased costs for building new homes. And then throughout 2022 and 2023 is where we saw a lot of builders collapse. So there has been a lot of change over the last 10 years. We've seen interest rates at a relatively normal level at the start of that, 2014, 2015. Then obviously rates continued to drop. And then obviously, during the COVID period, rates were at their all-time low. And we've seen over the last 12 months that rates have increased. And so whilst we can look at these big picture things like government policy, and we can look at things like COVID affecting the markets, the reality is that since 2014 through to 2024, prices in the property markets in most capital cities around the country have increased. So, that shows that we are in a relatively stable market in the property space, and that whilst we can't forecast any one particular month or quarter or year that's going to outperform, what we can predict over the medium to long term is that property will continue to grow. So specifically over the last 10 years, there hasn't been any major events other than COVID that have affected property prices. And, I think those that bought during 2020 are the ones that have done the most. Done the best out of the last 10 years because a lot of people were panicking. Yeah.
What about investor sentiment over the years? Has that changed at all?
Certainly changed over the last 2 or 3 years. I think because interest rates have done what they've done over the last little while, since 2020 through to 2024, it's been quite an interesting property market, and the sentiment in the marketplace, especially with builders going broke, interest rate rises, uncertainty around COVID. All of these things over the last 4 years have been quite an interesting time frame. But also we've seen over the last 10 years, a lot of baby boomers have started to retire. And that's something that we haven't really seen before in the Australian property markets, and we will continue to see for the next 5 to 10 years as the rest of them retire. And that's sort of changing the market a little bit, where a lot of people are selling their suburban home to move into apartments in the city. But also COVID has brought around changes to people's buying habits, in that people can communicate with families over video call now. They don't have to see each other face to face, and they've moved to regional areas. We've seen regional areas growing massively in the last 4 years. We've seen people changing their tree change and their sea change type properties, getting out of the suburban home. That was intended at the time. People were talking about the fact that people would move out of their big family home that have got 5 or 6 bedrooms. The kids have moved out, empty nesters, and that these retirees would sell the big family home, and that would free up more properties for first home buyers. But the problem is that these areas that they were selling in, often very expensive areas, and that didn't help first home buyers at all. So, and a lot of those retirees have actually retained those properties and simply rented them out. Yeah. So, I guess consumer sentiment has changed, I guess maybe shifted in the last few years. And with interest rates right now, I think people are sitting on the sidelines and waiting. But I've mentioned in previous communications that I think that the smart investors are out there investing now. Yeah. They're out there buying property now, because when interest rates do come down, and they will, it might be 6 months, it might be 9 months, but when the interest rates do start coming down, buyers are going to get back in the market again, and prices are going to increase. So my thinking around that is that if you get in the market now, then you're buying when there's less competition. When interest rates start dropping, more people will get back in the market, more competition for the same amount of properties. Yeah, prices are going to go up. So you either pay a tiny little bit more interest rate now, or you pay a higher price for the property in 12 months' time.
Yeah, it's interesting. I actually had on Chelsea Burton, the General Manager of Crown Money Management, this morning, actually, and we were talking about how we're currently in the most difficult lending environment that she said, or one of the most difficult in the last sort of 8 years since she started out in mortgage broking. And she made the comparison of 8 years ago, it was far easier to get lending and borrow money. What does that look like in your experience? Has that changed your investing?
I agree. Yeah, 100%. I mean, my own lending has definitely changed over the last 8 to 9 to 10 years or so. And I agree with Chelsea 100% on that, in that lending used to be reasonably straightforward. You'd fill out the application form, you'd submit it to the bank, and usually within a week or so, you've got some sort of understanding of where things are at. But obviously, one thing that has changed over the last decade is technology, and will continue to change, and it will continue to evolve the lending space. But I think what we have seen is a lot more scrutiny from the banks. They've got access to more data now, and when I say banks, I mean lenders in general. People refer to banks as being the only ones that can lend money. There's about 300 lenders in this country, and most people think of the big four as being the only ones. But yeah, lenders really have access to more data. They've got access to ATO data. They've got access to other banking data and all sorts of, I guess, big data that they can analyse you as the applicant to really determine whether they should lend you money or not. So that has definitely changed, and there's a lot more scrutiny. They're going into much more detail. They're literally going through your bank accounts now, through your bank statements, to see what you spend your money on. So if they can see that you spend money at the pokies every week, or if you spend a certain amount of money at, Dan Murphy's, for example, and you've got, maybe I'm not saying a drinking problem, but if you're saying if you've got to spend a certain amount of money, they want to see where your money is going, and they're looking at everything. They're not just looking at high level stuff anymore. People forget that when you're an investor and you're buying a property and you're getting funding from a lender, you're typically putting in 10 or 20% to the property. The lender is putting in 80 or 90% of the value. So, us as really smart property investors, we're going out there and looking at whether a property is a good investment or not, and making really savvy, smart decisions. And this is a good area, and I'm going to make a good investment. You've got to remember that the banks are looking at the property as well. They're doing their valuations. They're doing their own assessments behind the scenes. They've got, teams of very skilled and intelligent people, one would assume, to analyse the property and whether it's a good deal. But they're also looking at you. They're looking at whether you are a good investment. So before they lend any money to you, they're looking at the property like you are, but they're also looking at you, and they're looking at your figures and your financials, what industry you're in. Obviously, with the growth of AI and what we're seeing in technology space right now, that's going to change. Banks are going to be looking at what career you've got, what industry you're in, and whether that industry might become obsolete in the next 10 years. That might be a role that could be taken over by AI. Yeah. Banks are going to be looking at that sort of thing for the next decade or so to see whether you're going to have a job. Yeah. What skills you've got. So all of these things are coming into the lender's decision-making process. That's definitely changed over the last 10 years, and certainly will change more in the next 10.
Yeah. So how should investors be thinking about this when they're looking at expanding their portfolio?
Well, look, the way I look at this personally is that you can't control a lot of these things. If you're an investor listening to this, you can't control what's going to happen with the banking space, the lending space. You can't control that. You can't control what the banks are going to do with interest rates. You can't control the scrutiny that the lenders will have over your loan application. They're going to do what they're going to do. And you certainly can't control, technology, AI, and all of these things that are happening in the marketplace right now that's going to change the way people buy property and also the way that people get loans for properties. So, from my perspective, I don't make decisions on anything that I can't control. If I can't control it, why should I worry about it? Yeah. So the end thing that you should be really thinking about is, what is your end goal? What are you trying to achieve through your investing, and work backwards from that? Yeah. Now, I've always said this, is that you can only control what you can control. And if you know what your end goal is, all you need to do as the investor, working closely with your mentor, of course, is to adapt and change your strategy from time to time, because you might set out a plan today that you think is going to work perfectly for the next 5 years. The reality is that things are going to happen in your life, and there's things that are going to happen in the property space. There's things that are going to happen in the lending space that you can't control. Yeah. So when you've got a mentor by your side, you've got somebody to talk to about your situation and how you can adapt and adjust your strategy to still get you to that end goal, knowing that governments are going to do what they do, lenders are going to do what they do, the tax office is going to do what they do. A lot of these things that you can't control, but you can adapt. Yeah.
Obviously, your 10 years helping people grow wealth through property has been successful, otherwise you wouldn't be here, but a lot of companies have come and go. How should people go about finding a mentor and someone to help them throughout this process?
Yes, we have seen a lot of companies come and go. A lot of people that we speak to say, well, look, I don't want to do what you guys do. We want to make some quick money. And the reason for that is a lot of people don't plan for their financial life as well as they do. You know, people often spend more time planning a holiday than they do planning their financial future, which is insane, really, when you think about it.
Yeah.
The impacts that you can have on your financial future just by spending a couple of hours a month on putting your plan together and having a chat to some experts about it. But the reality is that if you are spending some time working on your plan, you don't need to go and chase the latest shiny object. And a lot of companies have been set up offering huge returns and get rich quick type marketing that really does attract a lot of people in. And it's sad to see people, even to this day, still getting suckered into these marketing strategies where they're advertising huge returns and, risk-free and, all of this stuff that's just not true. It's blatant lies, and these companies go under and people fall for them. They start up and they close down again. People fall for these marketing tactics that are really there to sucker people in. For me, long-term investing is about being sensible with your money, being sensible with your decision-making, and really investing for the long term.
Yeah.
If you're looking to get rich quick, go to the casino, get it over and done with, right? Take all your money down there, put it on red or black, and then at least you're doing it painless, right? Get it over and done with.
Yeah.
Otherwise, if you don't understand the fundamentals of investing, if you don't understand why you're investing in the first place, and you don't understand essentially what you're investing in, then don't do it.
Yeah.
Right, you're better off going to the casino because then you are taking just as much of a gamble and you're making all of the decisions. The problem that people have out there is that they're often time poor. They've got a career, they've got kids, they've got jobs, they've got things that they've got to do, and what they'll do is often trust an expert in the property space or in the investment space to just give them the advice. And when things go wrong, guess who gets the blame? Or we'll blame the company that put me into this.
Yeah.
The reality is that you as the investor get to make a decision as to whether you're going to invest your money or not.
Yeah.
And you as the investor get to make a decision as to whether you're going to buy that property or you're going to put it in the stock market or whatever you're going to choose to do. Our focus at the Property Mentors is to really educate people first.
Yeah.
So if you go through that education process and you decide that you don't want to invest in property, then don't do it. Right? We're not here to twist your arm and force you to do something you don't want to do. And at the same time, if you do choose to invest and you choose to invest as property as the vehicle that you want to use to build wealth, then at least when you are investing in that particular property or that property strategy, that you understand it.
Yeah.
And you know what you're doing, you know why you're doing it, and you know how it fits into your plan. But the problem is people get in their stage in their life, often in their mid-50s, people freak out and they know that retirement's coming up. They have a bad day at work and they get home and they go, we need to do something, honey, or things are going to be bad in our retirement. So, I can just picture it in my head now, people coming home and they're grumpy after work. And then they get on the internet and they go and look for something that's going to help them make lots of money fast. Because if they'd done it in their 20s and their 30s and their 40s, they'd probably be okay. But people panic in their 50s because they know that retirement's within 10 years away. They can see it. They know that it's not far and they need to do something. And it's really sad when people actually jump online and they find a company that's offering 50% returns or 40% returns or some miracle number that's probably not realistic in the first place. But they fall for these things and often time after time they lose their money because they never understood the fundamentals of the investment. They never understood whether those fees are even commercially, possible.
Yeah.
So that's the sad thing is people don't invest the time in themselves to actually educate themselves. So, and this is probably a long way of answering the question, but essentially, for us, we want to teach people so they understand what they're doing, why they're doing it, how it fits into their long-term plan. And of course, at the end of that, if they choose not to invest, that's fine. That's great. At least we've done our job to help people through that process.
What I find interesting as well about your process and the way you teach people is, yes, you focus on the specifics like property sourcing, tax strategies, finance, and things like that. But a lot of the education is around the investor themselves. Why is that?
Us human beings, we're very emotional creatures. Right? We make emotional decisions. I can teach people the logic of property investing all day, every day. The logic and the common sense of property makes sense. And if I just showed you numbers and showed you data, it makes sense at a logical level. The biggest thing is that humans are emotional creatures and we make emotional decisions. So to focus on the investor means really understanding what thought processes you go through, understanding that your goals are different to everybody else's, understanding that, if you have a focus on your goals and the end outcome and you have the right team of people around you, then making an emotional decision is not going to come into it. You need to look at the logical side of things and make sure that you are making a logical decision with your investments. Yes, there needs to be some emotional connection to what you're doing, right? But we don't want to make emotional decisions based on the fact that we like the kitchen, or we like the location it's across the road from a park, or these things. Well, these things do come into it, absolutely. But a lot of investors are driven out there by emotion. And what that means is they'll see an ad online. Look, there's a hot spot. Jacob, I've told you 1,000 times about hotspots. What do I say?
Don't chase them.
Don't chase the hotspots. There's no point because it's already a hotspot. It's too late. Prices have already gone up, right? And then people talk about the next hotspot. The reality is that these are kind of stabbing in the dark. It's like trying to play darts with a blindfold on. Just hoping that it sticks. Again, these are chasing hotspots, and these types of different strategies that people try and implement for their investing is really an emotional decision. Oh, everyone's getting in there. I need to get in there before I miss out. That's 100% emotional decision. Now, there might not be much logic behind that because if it's already a hotspot, everybody knows about it. The best time to get into a hotspot was 6 or 12 months before it becomes a hotspot. But people don't talk about that.
And I think people miss a point too. They get sucked in, as you said, by companies' marketing and see success stories like you, and they think, it's easy to do when they see those big returns that companies are advertising, but they miss the point of property, which is just buy good assets and hold them for a very long time.
100%.
That's how you
those results have happened over many years. And often, if there is a get-rich-quick type scenario where someone's made $100,000 in 6 months, that's great, but can it be replicated for everybody? Can everybody do that? And can you do it in any market? Oftentimes you can't, and I think the problem is with that is that stuff is, if not deliberately misleading, it is misleading in some sense that it can't be replicated for most people. I like to be really transparent and honest in our business dealings. We can't help everybody, and that everything that we do is for a long-term focus. If you buy a property and you sell it 2 years later, you're probably not going to make any money. If you buy a great property and you look after your finances and you work closely with your accountant to get the best tax benefits from that, you work with your financial planner to make sure your super is looked after properly, you work with your mortgage broker to get the best interest rates and refinance when you need to, work with your mentor to get you the best opportunities and do the research that a lot of people seem to skip over that part. It's a very important part to do that research. If you do all of these things and you set out a long-term plan over a 5 to 10 year period or more, then it is quite a simple process. It's not easy. Like they say, if it was easy, everybody would be doing it. But it is actually quite simple. And if you can take the emotional element out of that, or at least dilute it a little bit, focus on the education, then you're setting yourself up for a much better chance of success.
Yeah, I've had someone actually ask me when, having these conversations about investing in property, what return can you guarantee? Even with hotspots and areas, no one can really forecast what an area is going to do.
Well, I can tell you, if you want a guarantee, put your money in the bank and you can be guaranteed that they'll pay you a really small interest rate on that money, and the bank will guarantee the federal government will guarantee your deposit up to, I think, $250,000. That's the only guarantee that you're going to get with any investing. No one's going to give any guarantee. I can't forecast with any of the properties that I've got what they're going to do over the next 12 months. Nor should I try and work that out. All I want to do is look at long-term averages and go, if it does the long term, the average over the long term, then this is my result. But I'm not going to predict that this year's going to do 6%, next year's going to do 9%, the year after might do 12%, the other years it's going to do 3%. There's no point, and it's really going to be a waste of time. The only way you can really track those numbers is in hindsight, looking at historical data. But again, if the fundamentals of the property are there, then you know that you're making some good investment decisions. Got to look at the fact that our cities are getting bigger, but they're also getting more compact. And that means that older houses in good areas are getting knocked down and they're putting 3 or 4 townhouses on. Older houses and older buildings closer to the city getting knocked down and they're putting apartments on them. So what we're seeing is that over the last 100 years or so, we've had infrastructure built up in our capital cities. More people are now having access to that infrastructure with existing shops and schools and train stations and freeways that are already there. They're just putting more people within access to that. And so we are going to see over the next decade that our cities are going to change with higher density.
Do you think that's a good thing, bad thing?
Look, I think
Doesn't matter?
well, there's twofold to that. One, it means that we're going to have more people putting pressure on existing infrastructure, which means that the governments are going to have to upgrade things like in Victoria, tram networks and hospitals and schools and shops and things like that. They're fitting more people into these areas. They're going to have to try and squeeze more people into the school system. That means upgrading schools and things. But it also means that they don't have to keep putting freeways, hospitals, schools and shops and other amenities on the outer fringes of cities. Now, some cities like Perth and even Melbourne in the west in particular, Brisbane in between Brisbane and the Gold Coast, for example, these are some areas where there is a lot of growth and there is available land because it's part of their master plan for these cities, where there is available land that's already slated for development, brownfield or greenfield sites that they're chopping up into land blocks. That'll continue to happen, but we are going to see a lot more consolidation of these cities over the next 10 years.
Well, before we go on to the next 10, 20 years, Luke, you mentioned before one of your biggest regrets throughout your investing career was not buying more property. Do you have any other regrets?
Look, no regrets as far as my property investing career is concerned. I guess, look, anyone, if you look back 20 years ago, oh, geez, I wish I could have bought 20. I would have bought the whole street if I could. But, the reality of that is that I didn't have the borrowing power to do that. And I was a very ambitious 20-something. I was very motivated to build wealth through property. I understood from a very young age that property was a great vehicle to invest in. And I think I loved buildings from a young age. I loved looking at nice houses and swimming pools and ocean views and all of the cool stuff. And I wanted to have nice cars and live by the beach and all of these things. So I loved property as just a kid. I loved buildings. And then I realized that property investing can help you build wealth. Geez, that makes sense. And if the bank's going to lend you 80 or 90%, that makes even more sense when you use someone else's money to do it. So, yeah, look, I think from a regret perspective, I don't have any specific regrets. The only thing that I did probably do that I could have done better over my first 10 years of my investing from about the year 2000 to about 2010 was trying to accelerate my wealth creation. And what that meant is that I did everything that I teach now not to do. Funny enough, I learned from those mistakes. And so what I did was I bought my first property. I did a renovation on that. That was the first property that I lived in. Moved out of that, rented it out. Then I bought an apartment. And then I went and renovated that. It was an old apartment. And then after that, I was reading Steve McKnight's book, 0 to 100 Properties in 3.5 weeks or whatever the book was. And, he was talking about buying in mining towns and buying in very affordable areas. And that's where Bendigo and Ballarat were $60,000, $70,000 homes. It's a long time ago because they're $500,000 now. And so I went and bought in a mining town. Positive cash flow, because everyone said you need positive cash flow. So I went and did that. And then I went and bought off the plan. I bought an off the plan apartment. And then after that, I went and did a renovation or two. I did a small subdivision. And what I was trying to do through my 20s was trying to accelerate my portfolio. I was trying to make it go faster because, after the first 2 or 3 properties, my mortgage broker at the time said, look, you can't borrow any more money. So you need to either sell some property to free up some equity and go again, or wait. You need to wait for the values to go up, wait for your rents to go up, or wait for your income to go up. And I was too impatient for that. So I wanted to go out there and do developments, and I thought that was the key to riches. So I guess when we're talking about regrets, I don't think I've got any specific regrets other than learning experiences is what I would put it down to, as things that I could have done better. But I think at the time I didn't. I actually thought in my 20s, because I was quite a cocky little 20-something, I'm now a cocky little 40-something, but I actually thought I could do it all on my own. I think that's probably the biggest mistake that I've made through my investing is not getting help. I thought I was getting help from my accountant, but all they were doing is giving me accounting advice. I thought my accountant was there to help me build wealth. That's not their job. They're there to look after my tax affairs. So that's why an accountant is a tax accountant. That's their full title is tax accountant. My mortgage broker as well, he was also a property investor. I thought if I'm going to have a mortgage broker, they should be a property investor. So I found one.
Yeah.
He gave me advice based on what he'd done. So I was going to him for advice when really all he was skilled to do was to get me a loan. That's his only qualification. He had a few properties. He had 2 or 3 properties, but he wasn't an expert property investor. Yet I was going to him trying to get advice from him. And then again, me being a tight ass, and we've done an episode on that. I wanted to read every book under the sun. I went to free seminars, and I'm like, I'm not paying any of these idiots. I'm not paying any courses. I don't want to do any of that. And I thought I could do it all on my own. And to an extent, I did. And I've never lost any money on a property deal. But because I did it all on my own, I didn't actually speak to somebody that actually had my best interests at heart and helped me plan out my long-term goals. And this is where the Property Mentors was established, because me going through this in my 20s, I realised what was missing was having somebody that actually was looking out for me and making sure that I made good decisions. There was nobody out there at any of these property seminars or events that I went to that was talking about me and my goals. All of the property companies were out there saying, look at this property, look at this area, look at the growth you'll make, you'll be a multimillionaire, and all of this stuff. None of them were talking about me as the investor. And I was thinking, why aren't they talking about me? The reality is, if they don't care about my goals and they don't ask me about my goals, they don't understand what I'm trying to achieve, they don't care.
Yeah.
Right? So why should I work with these people? So that's why the Property Mentors was set up very deliberately to help people understand that, you know, the investing is more than just buying a property. It's not just about getting the best tax outcomes and getting the best loans and finding the best property. There's no such thing as the best property. Properties are different for everybody in every market. There's, you know, pluses and minuses for every property. But yeah, I think the thing to consider is that when we set up the Property Mentors, it was really focused on the investor and making sure they understand why they're investing in the first place.
Yep, so that's most important.
That's it.
So a lot of people say, and we are in a very lucky country in a lot of ways, but will we continue to be lucky when it comes to our growth and opportunity?
Look, the world is in a very different place to where it was 10 or 20 years ago. Different geopolitical things happening around the world. We've got the impacts of China, and we've got the Ukraine and Russia war happening. We've got some ongoing changes in Europe that are happening over there and sort of changing things. And obviously China on our doorstep and the changes happening there, and the discussions with the US, depending on which president gets in later this year. It's going to be quite an interesting and possibly turbulent year ahead. And then, of course, you've got the China-Taiwan issue. So, look, the world is in a very different space to where it has been. The reality is, yes, we are still the lucky country. And for me, particularly, knowing that, you know, maybe we're not as lucky as we used to be, but I still think we're quite lucky in the sense that, you know, when I travel overseas and I come back to Australia, I realise how lucky we really are. And a lot of people that that were born in Australia and grew up here, they don't recognise that. They haven't actually seen that. Either they haven't travelled overseas and made that connection, or they've been overseas and just expected that, you know, it is what it is, and Australia is just another country kind of thing. But I really do see that we are in a unique position here. We've got a very healthy economy. We've still got an amazing credit rating as a country. We've got plenty of growth. We've got good education systems here. You know, our currency is stable. Our government is stable, certainly more stable than it was in the last 10 years, changing prime ministers every couple of months. We are still the lucky country in the sense that we do have good population growth. We've got a reasonable immigration policy. Probably needs some work, but, you know, at the same time, getting more skilled people into this country is going to have to be a priority for us if we're going to continue to grow. But I think that the opportunities specifically for property investors are going to be fantastic for the next 5 to 10 years or more. There's no reason why that's going to change. I do think there are some amazing opportunities out there now, specifically because people have sat on the sidelines with interest rates rising, and that those that are getting in the market now and holding on for the long term are going to do exceptionally well. We are shifting more as a country towards renting becoming more normal. People in Europe, they've been renting their whole life. You know, you sign a 10-year lease in parts of Europe and you bring your own kitchen. You fit out your own kitchen and people lease for 10 years. That's the norm. That's what happens there. And it's not like it's the norm across the globe, but that's, you know, we're in a situation now where more people are choosing to rent. And, you know, when I was growing up as a kid, you sort of, I mean, this is just in my experience, but when I was growing up as a kid, you sort of, the kids that were renting were sort of, what's wrong? Why they're renting? What's wrong? There must be, you know, something's going on there, or, you know, it was an odd thing for somebody to be renting. Why don't your parents have a house? And often the rental properties in any particular street, you knew which ones they were because they were the ones with the dead grass And
Smash windows.
well, not so much
cars.
smash windows, but it was very much, you could tell, because they just weren't maintained. They weren't looked after. You know, they needed a paint job and the gardens were a bit scrappy, and you knew which ones that weren't owner occupied.
Yeah.
Now you could drive down any given street and you wouldn't have a clue which one's the rental property. And, you know, we're talking a good 30 years ago. I mean, I was 10 years old when I was sort of going through this sort of thing. But really, when you're looking at the population over the next, 5, 10, 15, 20 years or so, Australia's going to be, more people are going to be renting. They're going to be more accepting of the fact that I'm renting for life. And a lot of people are choosing to, take on this digital nomad kind of lifestyle where they can live in Bali for 6 months and then come back and live in Australia and then maybe move to Perth or move to Sydney, wherever they choose, and have that flexibility. And, that's a choice now rather than people having to rent because they can't afford to buy. People are sort of choosing to, I read an article a couple of days ago where there's families that are literally buying a caravan and they're literally traveling around the country. That's what they do.
Yeah, cool.
And they have given up on buying a house or renting as well. And they're just in a caravan or a bus and they're driving around the country. So I think what we are going to see is that is going to pose opportunities for investors that want to keep accumulating wealth through their property portfolio, and that there are going to be significant opportunities with people downsizing, like I mentioned earlier, with retirees, baby boomers continuing to retire. That's going to change. This is the biggest retirement shift in our history in this country, with all of the baby boomers beginning to retire. And a lot of those baby boomers will retire and continue work. They might do another 2 days a week, going back to their old job or go and do something that they've wanted to do. But that is going to put pressure on the housing supply as well and change the way people live.
Yeah, it's interesting going back to the renting and owning a home. It seems like there's a bit of a shift going on with the great Australian dream, as it's called, of buying your own house and living in it. A lot of people are, as you said, choosing to rent, but also they're choosing to invest first rather than buy their home to live in it, with the idea of building up their property portfolio first so they can buy a better, bigger house later on in life.
We've definitely seen that over the last 5 years in particular, where rent vesting has been a thing, and it's sort of become a bit of a buzzword, but not a lot of people really understand it. Understanding that rent vesting is going out there and renting first while you continue to invest or while you start investing. And like you said, delayed gratification is something that it's almost unheard of now. Everybody wants everything instantly. You've got an app for everything these days. You can get anything that you want, food delivered, drinks delivered, dating apps, you can have everything delivered literally. And, people sort of expect everything now. Delayed gratification is what I grew up with. You invest now and you get reap the rewards later on.
Yeah, I think it makes so much sense from a freedom point of view as well. And I would almost argue it's not delayed gratification in a sense, because you get to go and live and rent where you want. You might not be able to afford a house in the city, but if you rent first, you can go live in the city, have that lifestyle that you want now, but also grow your wealth in the background.
Well, if you look at the typical mortgage, we're talking about 30 years. So even if you're in your 20s, you're 25 years old, you go and get a mortgage and it's a 30-year mortgage, you're going to pay that off at 55. When do you start investing? 56? The reality is that if you go out there and invest while you're 25 or 35 or 45, then at least you've got those years to build up your wealth outside of owning your own home. And at any point in time, you can sell that and go and buy your own home. You get to make those decisions. But I guess a lot of people are just saying, no, I want to get my own home first and then I'll invest later. But the problem is with that is often when you get your own home, you get all the trappings that go with it. You get the new TV, you want to upgrade the garden, you want to put a new fridge in, you want to have new furniture, and then you go and have some kids and then they need stuff, and then you want to upgrade the car, and then you need to do holidays. This is what happens, and the society's been set up this way. I don't know, whoever set it up, the aliens from all these years ago, whoever set it up, they've decided that, we're all going to have mortgages and go out there and put things on credit and we're going to basically retire broke. It's a horrible system when you really look at it. And the only real luxury that you get from that is having a feeling that you own your own home. But most people are putting down 5 or 10% deposit, maybe 20% deposit on their own home to get into their first home. The bank owns most of it anyway.
Yeah.
So, that false sense of security that you've bought your own house that you live in, that the bank owns most of, which you fill up with a whole bunch of crap that costs you money on interest-free Harvey Norman payments and things like that. And, this is why, books like Robert Kiyosaki, Rich Dad, Poor Dad, talk about your own home being a liability. Yeah. It's not an asset.
It's an illusion almost.
That's it. And I think that's what people get stuck with, is saying, well, I want to buy my own home rather than invest. If you flip it around the other way, if you do the figures on it, you look at the fact that investing first can make so much more sense. If you're in your 20s or 30s and you can buy 2 or 3 investment properties over a 20-year period, let's say you buy one every 6 or 7 years, right? By the time you get to 50, 55, you've got a few investment properties. You could sell 1 or 2 of them, and then you've got enough money to go and buy your own home. The planning behind that is actually not that difficult. Sticking to the plan is the emotional side of things that we were talking about before. That's where they go wrong.
Yeah,
I work hard. I deserve this. I deserve to take some money out of my equity and go on a holiday.
Yeah,
then people take money out of their equity because the banks offer it. People go on these holidays and then it goes back on their mortgage and they never pay it off.
Well, it seems like there's exciting times ahead for a lot of people who are planning it and doing all these things. Anything you want to add to, I guess, the past 10, 20 years, anything about the future or anything else entirely?
I love property investing and what it can do for people. And I think that realistically, over the last 20 years, there has been some amazing growth in the property markets. We've had huge construction booms here in Australia, and that's going to continue for some time to come. We've had a relatively low interest rate environment, and I think things will calm down a little bit with inflation and so forth over the next 12 months. There are still some headwinds for the property markets and for our economy over the next 1 to 2 years in the short term. But obviously, we'll have to see how that plays out. Obviously, the US election in November this year is going to be an interesting time for Australia and other Western countries as to whether Trump gets in and whether Biden stays in. That's going to change things a little bit. That's a whole nother conversation. We won't go into that on this podcast. But, I think, overall, if you've got a long-term focus with your investing and you do understand that it's not a get-rich-quick scheme, if you get help, in other words, putting a good team of accountants, financial planners, mortgage brokers, solicitors, and of course your property mentor to help and guide you through it, and and understand that it's a long-term plan. Now, long-term doesn't have to mean 20 or 30 years. If you're in your 40s or in your 50s, you can still put a plan in place.
Yeah.
It just might be a different plan to someone that's in their 20s. But if you've got a plan in place, imagine if you hit 80% of your goals. It's better than hitting 0%.
Yeah.
Right? So, if you can hit some of your goals, that's fantastic. We'll do whatever we can to help and educate along the way. But look, I think it's better than burying your head in the sand.
Yeah.
And I think the biggest challenge for people is not so much trusting somebody else to help them on their journey, it's trusting themselves. If you don't have a history with good money management, if you don't have a good history with investing, maybe you've lost money in the past, if you've got habits like potentially going down and gambling your money, these little things can chip away at your long-term wealth and success. If you are one of those people that just thinks it's all too hard and I can never do this and building wealth is for other people, you just need to get those thoughts out of your head and have a chat to somebody that can potentially help you. And if you have a chat to one of the mentor team and decide that, hey, this is just not for me, that's great. At least you've had the chat. Probably cost you 30 minutes of your time, but at least you've explored it. The thing is that with wealth creation and your retirement, no one's going to do it for you. And this is the biggest thing that I like to reinforce to people is that if you don't do it, who's going to do it for you? And if you don't do it now, when are you going to do it?
Yeah.
You can always find an excuse not to learn about your investing and find an excuse about why you shouldn't invest and now's not the right time, I'm going to sit on the sidelines. That's great. Let other people make money.
Yeah, so easy to put it off, but so important not to.
Absolutely.
Well, for those listening, Luke, I will put a link to the Property Mentors if someone wants to reach out and have a chat with a mentor, help get a plan in place for this. But I do appreciate you coming on again and look forward to the next one.
Thanks, Jacob.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.